Right, so we're gonna keep building up our knowledge of GAAP. So we talked about the qualities of GAAP already. Remember, GAAP stands for Generally Acceptable Accounting Principles. So another word for qualities we could use is qualitative characteristics, but now we're going to talk about the principles or assumptions. So these are what the financial statements or the transactions that lead up to the financial statements are based on. So these are very, very important. The first one is separate entity. So this means the only the activities of the business are included in the business financial information. So for example, I run my tutoring business out of my personal house, but my personal life and my business have to be kept separate. Simple as that, right? So if I buy a TV for personal use, I can't put it under my business as a business expense. The next one is unit of measure. All transactions must be reported using the monetary unit of the country the business's head office is located in, even if the business has offices in many countries. So, simply put, I also tutor clients in the United States. They pay me in USD. But since my business operates in Canada, when I prepare my financial statements, I have to put everything in the currency of the Canadian, right? So I can't have USD and Canadian on my financial statements. I have to convert everything over to Canadian. That's all that means. The going concern principle is confusing. It's kind of hard to explain, but it means businesses will continue the operations well into the future. So simply put, a manager must conduct operations with the attention the business will operate in the foreseeable future. Because if you think about it logically, if the manager knows that the business is going to shut down soon, they're going to start making questionable business decisions. They might sell an asset for less than it's actually worth, which at that point, that puts the shareholders, or sorry, even all the stakeholders at risk, right? The historical cost principle states that all purchases will be recorded at the amount that was paid for them. So a prime example of this is, let's just say we buy a vehicle. So the vehicle's market value is $15,000. The person has it up for $13,000, but we negotiate a price for $11,000. And that's the price that's on the invoice. So we pay $11,000. So that's the price that we're going to record it at in our financial statements, right? Which is the invoice price. It's the price that we actually paid for it. The, the time period principle, information is broken down into artificial time periods such as month, quarter, or year so that stakeholders can analyze and compare information to make decisions. So this principle here relates to a bunch of qualities that we've already discussed before, right? So in accounting, a 12-month period is called a fiscal year. Majority of companies use a calendar year as a fiscal year, which is January 1st to December 31st. However, a fiscal year could be any 12-month period, but it has to be consistent for comparability purposes, right? So companies are required to issue yearly statements, but some companies also do quarterly and monthly. If you're a public company, you have to do quarterly as well. That's just required by law. And the full disclosure principle states that if something will affect the business, if something will affect the decisions of the external stakeholders, it must be reported. Remember, we talked about external stakeholders already. These include shareholders, the governments, customers, suppliers, creditors, society/community, right? What we just learned, we're going to do problem PQ16. I'm skipping PQ15 just because we've already talked about it. So you have already seen the scenarios below. When you looked at the qualitative characteristics, which we just did in the past video, now that you know the assumptions, choose the assumption that you think applies to indicate if it has been violated, not followed, or followed. Be sure to explain why you think that is true. More than one assumption may apply. So ABC Company has always included a 12-month period from the beginning of January to the end of December in its financial statements. This year, because December sales were very poor, the business has included 13 months from the beginning of January to the end of the following January. So this one, obviously the time period assumption is violated. Goes without saying because they included 13 months just because it looks better. You can't do that. And remember, artificial time periods must be consistent from one period to the next. And that's not the case here, right? Okay. For the next situation, HDD company is a new business that just started out. At the end of the year, the company's accountant checks how other businesses in this industry are recording their business transactions and ensure HDT uses similar policies. So none of these assumptions are directly applicable, right? However, if you think about it, the new accountant is going to use both these assumptions, all of them, and these qualitative characteristics to these transactions, right? So nothing applies to a specific example. However, they're still using GAAP. The next example is DHD company has not produced financial statements in 2 years. The bank has asked repeatedly, but the owner of DHD company has ignored the bank's request. Once again, the time period assumption is violated just because we have to produce at least yearly financial statements, which this business is not doing at all, right?